Okay, let's unpack this. We are diving into one of the trickiest corners of the market today. It's a classic bone deep value dilemma. The company is James River Group Holdings, ticker JRVR. And just to set the stage, this is a stock that was trading near $50 a couple of years ago. Now, as we're talking, it's struggling around $6.31.
Wow.
That is a truly catastrophic price collapse.
It is. And that kind of destruction, it demands a forensic investigation. The price action alone tells you the market believes this company is deeply, deeply flawed. So the core question for us, and we're applying the strictest Graham Buffett Munger investment framework here, is whether the business that remains is fundamentally impaired.
Is it a value trap?
Exactly. Is it a slow-eroding, toxic value trap, or has the trauma of the past created, a statistically cheap cigar butt?
And maybe we should clarify what those terms mean, just for anyone new to this type of deep value analysis.
Good idea.
So we're asking if this company is a cigar butt, basically, a dying company with maybe one last puff of profit left in it, where the assets can be liquidated for more than the current market price.
Right. Or, on the flip side, is it a compounder, a high-quality business that's built to last?
Because James River Group, which is an excess and surplus insurer and E&S player, has failed almost every single quality metric over the last decade. And yet it's trading at this massive discount to its stated tangible assets.
Exactly, and that's the tension. Our mission today is to verify the integrity of those assets. We're looking for that point of maximum tension. Can new management actually clean up a decade of disastrous actuarial errors, or is the intrinsic value of this company, permanently impaired?
So, more pointedly, the opportunity here, if there is one,
it exists, yeah,
is asymmetric.
Huh.
Are you paying for a deeply discounted, maybe dying asset, and getting a profitable new business engine thrown in as a free call option?
That is the whole game right there. That tension is what drives this deep dive.
So for you, the listener, you need to understand this is not for the faint of heart. This requires the stomach for deep turnarounds. We're not searching for a steady, predictable compounder like a Coca-Cola or an operational superstar in the insurance world like Kinsale Capital.
Not at all.
This is a distressed asset play.
It is. And along the way, we're going to break down some complex insurance concepts, things like float, social inflation, reserve development.
And the financial lifelines of this turnaround, these things called loss portfolio transfers, or LPTs, and adverse development covers, ADCs, we'll do it in plain, understandable English.
And of course, the standard disclaimer. All the analysis we're doing today is based on publicly available sources. It's all for educational purposes.
This does not constitute investment advice.
Absolutely not. You must conduct your own due diligence before making any investment decisions.
And if you want more of these deep dives or more advanced content, you can always join the Deep Value Club membership or subscribe to the Deep Value Investing podcast channel or on luluvc.com.
Okay, we've got a lot of ground to cover. I think we should start with the qualitative assessment that Buffett always mandates.
Right. Can this business ever be great, regardless of what price you pay for it?
Well, let's find out.
We have to start with the non-negotiables. Before we even look at a single balance sheet number, we have to figure out if this is a good business that just hit a temporary rough patch.
Or if it's a fundamentally flawed business that's just, permanently operating in a good industry.
Because if it fails these gates, we just stop right here. The price doesn't matter.
Exactly. So gate number one, the first test is simplicity. James River operates in the excess and surplus market, or E&S. We have to pass what we call the elementary school test. What exactly is JRVR?
Okay, I'll take a stab at that. They are essentially the insurance store for risky things.
I like that.
So if you're a standard or admitted carrier, think State Farm or Geico, you insure basic, predictable risks. A standard family car, a typical home. E&S carriers, they're the only ones who will insure, say, a massive construction crane operating 50 stories up in a hurricane zone.
Or a newly legalized cannabis cultivation facility.
Right. Or the liability for some complex chemical manufacturing process. They take on all the risks that the standard carriers reject.
And the mechanics of this are what make the E&S industry so structurally attractive. They collect these high premiums up front, which immediately generates float.
And float is that pool of money they hold and get to invest before they have to pay out claims, which could be years later.
Precisely. And critically, unlike the admitted market, E&S carriers have what's called freedom of rate and form.
So they don't need to get slow, bureaucratic regulatory approval to change their policies or their prices.
which means they can react instantly to changes in risk.
That structural freedom really is the gold standard of the insurance world.
It is.
And the demand for this kind of product is durable too, right?
Mhm.
The whole E&S market has seen massive, predictable growth.
Huge growth. It's swelled from what, about $11 or $12 billion in 2000 to over $100 billion today.
And that's driven by our world just getting more complex and risky, and this thing we call social inflation. So the neighborhood is definitely a good one.
So here's the question then. Why the caution? If the business model is simple and the demand is durable, why the spectacular failure at James River?
It has to come down to predictability.
It does. JRVR specializes in long-tail casualty insurance. They collect a premium today for a massive liability exposure, but the claim might take 3 years to even be reported.
Then 7 years to litigate.
And 10 years to finally settle. So their entire business model rests on their ability to accurately estimate risk that far into the future.
Which is incredibly difficult.
It introduces massive estimation risk, and historically, James River's liability estimation has been, to put it mildly, spectacularly unpredictable.
They kept saying their reserves were adequate.
Repeatedly, only to find out years later that they were short by tens or even hundreds of millions of dollars.
So the core mechanics are understandable. But JRVR's historical execution has just failed the predictability test over and over again.
That's the key risk.
And we also have to talk about the technology gap. You mentioned that the big structural winners, like Kinsale Capital, are using proprietary tech and AI models for automated low-touch underwriting.
Right.
This gives them a structural cost and efficiency advantage that JRVR, which relies on a more traditional wholesale broker model, just doesn't have.
And that structural disadvantage is key.
Yeah.
Technology won't make the fundamental business obsolete, but it does mean the really efficient players capture the best, easiest to price risks,
Leaving the more complex, higher volatility risks for the slower, higher-cost players like JRVR.
They're left with the hard-to-underwrite scraps.
So for Gate 1, our verdict is, we understand the business, but we absolutely do not trust the estimation.
I'd call it a conditional pass. The core insurance model is simple and understandable. It's within our circle of competence.
Right.
But we have to proceed with extreme caution, knowing that this history of disastrous liability estimation errors introduces, frankly, existential risk.
Okay, on to the most critical question. The moat test. Buffett always demands durability. What competitive advantage does JRVR have? And, more importantly, will that advantage be even wider 10 years from now?
Well, given the price collapse, the market's answer seems to be none, but we need to prove it forensically.
So how do we test it?
We use two measurable criteria. First, the cost advantage test, and second, the intangible asset test, which in the insurance world really just means consistent underwriting discipline.
Okay, let's start with cost. The expense ratio is the measure here, the cost of running the business, commissions, overhead, all that. A structurally lower ratio is a durable moat.
And James River's reality here is, well, it's troubling. Their consolidated expense ratio has consistently been between about 28 and 31%.
Why so high?
They're fundamentally relying on a high-commission wholesale broker model to bring in that high-volatility business we just talked about.
And when we look at the operational superstar in this industry, Kinsale Capital, what's their expense ratio?
Kinsale is consistently around 20.7%.
Wow. That stark difference, it just reveals the structural chasm between them.
It does. James River operates with an 8 to 10 percentage point structural disadvantage compared to the industry leader.
That is a massive headwind. Just think about the implications of that. JRVR has to be 10% better at picking risks at underwriting, just to break even on efficiency compared to Kinsale.
Which is?
How realistic is that in a commoditized, high-risk market?
It's Herculean, maybe impossible. And that brings us to the second test. Intangible asset or underwriting discipline. The metric here is the combined ratio. That's your loss ratio plus your expense ratio. You have to consistently stay below 100% to make an underwriting profit.
And this is where JRVR's history goes from ugly to disastrous.
Extreme destructive volatility. If we look at their recent history, especially when these big reserve charges hit, they post terrible numbers. Q3 2024, for example, they had a staggering 135.5% combined ratio.
So for every dollar in premium they collected, they were paying out $1.35 in costs and claims.
They were actively destroying shareholder capital at a rapid pace.
Let's benchmark that against consistency. What does the epitome of stability look like in this space?
You look at a company like RLI Corp. They've achieved a combined ratio below 100% for 28 consecutive years.
28 years.
That is a true, durable moat built on institutional discipline. And Kinsale, as we mentioned, consistently posts ratios in the mid-70s.
So they make a 25% profit on underwriting before they even start investing the float.
Right. And by contrast, James River has acted as the financial patsy at the poker table.
They wrote business that was fatally underpriced. The most infamous example being the Uber or Razier commercial auto account, which generated catastrophic multi-year losses.
They failed the most basic test of ensuring the premium you collect actually covers the claim you eventually have to pay.
So a true franchise just doesn't concentrate its risk in a single unproven account like that.
No, it speaks to a fundamental lack of disciplined risk management in the prior regime.
Okay, so the verdict on Gate 2, the moat test.
It's an undeniable fail.
No debate there.
It lacks both the cost advantage of the technological leaders and the demonstrable discipline of the niche specialists. If a moat is the primary reason to pay a premium for a stock, JRVR has no moat.
Which means the only reason to buy it is the price.
The only reason.
All right, so if the business quality is core, we have to turn to management. Can brilliant management fix a broken business? Frank D'Orazio, the current CEO, he clearly inherited what the source material accurately calls a burning building.
Absolutely. So we have to judge him on the cleanup, not on starting the fire.
And his tenure so far has been an exercise in triage, right? Making rational but intensely painful decisions to stabilize the company.
That's right. The first necessary move was divestiture. They sold the toxic JRG Re unit, which was their casualty reinsurance segment, to Fleming Intermediate Holdings.
That sounds very clinical, but what that was literally excising a balance sheet tumor.
It was. It was a unit that just kept generating unpredictable multi-million-dollar losses. Cutting it off stopped a major artery of bleeding.
And the second painful decision.
De-risking. And this is crucial to the investment thesis. They purchased expensive loss portfolio transfers, LPTs, and adverse development covers ADCs from giants like Enstar and State National.
So they paid a massive upfront fee to buy insurance for their own insurance company.
That's a great way to put it. It sacrifices future earnings capacity to ensure immediate survival and cap liability. For a distressed entity like this, that is the most rational, necessary trade-off you can make.
And the third signal of an owner mindset. They cut the dividend.
A huge signal.
They drastically cut it from 30 cents per quarter down to just 1 cent.
A weak, short-sighted management team would prop up the stock price with dividends until the last possible moment. This team explicitly prioritized balance sheet preservation over appeasing income investors.
That's a strong signal of an owner mindset, focused on long-term survival.
It is, but we have to remain skeptical. You can't just ignore the core integrity test here, which is the history of reserve deficiency.
Right. Management across multiple regimes repeatedly claimed reserves were adequate, only to take these massive charges later.
And even in Q3 of 2025, they took another $51.3 million charge on older accident years.
Wait, hold on. If the current management team is so disciplined, why are they still reporting reserve failures? Doesn't that just destroy their credibility entirely?
It absolutely destroys their legacy credibility. The market gives them zero benefit of the doubt today because of this history. The key, though, is to see if these new charges are related to decisions they made or if they are ghosts from the past that they are finally painfully admitting to.
So the market is waiting to see if they can finally draw a clean line under all of the old liabilities.
That's the whole question.
Okay, let's look for a redemption signal. You mentioned insider buying.
Yes, Frank D'Orazio made a significant open market purchase of 100,000 shares at around $4.75.
So that's a $475,000 personal investment. That's real money.
And that's exactly what Buffett looks for. Insiders might sell for 100 reasons, divorce, taxes, buying a yacht, but they buy for only one reason.
They think the price is going to rise.
Exactly. But to your point about skepticism, you have to ask, is $475,000 could be enough to offset the billions in shareholder capital that previous management destroyed?
It's a positive signal, but it only slightly tips the scale.
I agree. So for Gate 3, management quality.
I'm thinking mediocrity improving.
That's where I land too. Past management was catastrophic. Current management is making the necessary hard decisions. The insider buying and the focus on de-risking suggest positive intent, but execution remains to be fully proven.
Okay, Gate 4. Finally, we audit the neighborhood. Does the E&S industry itself provide attractive structural tailwinds?
Absolutely. The structure is inherently attractive. The E&S market acts as a necessary safety valve for the standard admitted market.
So when standard carriers tighten their underwriting standards, which they do whenever economic or litigation risks rise,
All that risky business flows directly to E&S, creating massive demand.
and they have pricing power, which is just paramount in this kind of inflationary environment.
That freedom of rate and form we talked about allows them to raise prices and change policy terms rapidly, reacting quickly to social inflation. It's a huge advantage over the slow-moving, regulated standard carriers.
Let's talk about that major headwind, though, social inflation. We're talking about the systemic problem of nuclear jury verdicts in U.S. courts. Can you elaborate on why this trend is destroying reserves industry-wide and how it impacts a company like JRVR?
Sure, social inflation isn't your standard CPI inflation. It's the cost of lawsuits just skyrocketing. A jury might award $5 million for an injury today that 5 years ago would have settled for $500,000.
And these massive, unpredictable verdicts retroactively destroy the actuarial estimate.
Exactly. An insurer might have reserved perfectly for an accident in 2020 based on historical trends, but if that case goes to court today, that reserve is suddenly catastrophically inadequate.
And since JRVR is so heavily exposed, 96% of its premiums are in casualty lines, they were sitting directly in the epicenter of this systemic risk.
Correct. The structure is attractive, but the environment is dangerous. The verdict for the industry structure itself, however, remains positive.
So it's a pass, the neighborhood is attractive, James River's house is just leaky and exposed to some very severe weather.
A perfect summary. So our qualitative analysis confirms this company failed the moat test and is defined by a management cleanup.
This is not a classic buy and hold forever compounder.
No, it's a highly speculative turnaround or a Graham-style deep value play. So we must now proceed to the forensic accounting to verify if the assets are real and if the stabilization strategy is actually working.
Okay, we established that the business model is inherently attractive, but JRVR's historical execution was, frankly, disastrous. So let's delve into the specific trauma that led to this collapse and where the unit economics stand today in late 2025.
The primary trauma for James River is what we call the Uber wound. For years, they were the primary insurer for Rosier, which is Uber's operating entity. And at the time, it looked like a tremendous, high-growth engine, a flagship account.
But it turned out to be a Trojan horse.
Right.
It looked great on the top line, but it was just fatally underpriced.
Exactly. It generated catastrophic losses because the reserves they set aside for these commercial auto claims were woefully inadequate.
And even though JRVR canceled that contract way back in 2019, the tail of that business continues to haunt the balance sheet.
That tail is the terrifying part of long-tail casualty insurance.
It's like having a bad credit card debt you thought you paid off 6 years ago, and now a collection agency is calling you again for the interest.
It's a great analogy. That ghost of a bad decision made 6 or 7 years ago can still generate hundreds of millions in charges today. It demonstrates the multi-year risk of these actuarial errors and why credibility is so important.
The market has a long memory, and that long-tail liability is why investors still assign such a heavy discount to JRVR's book value.
They assume there are more Uber-sized ghosts lurking in those older accident years.
So, has the core E&S business stabilized after all the cleanup and the sale of that reinsurance unit? Let's look at the most recent snapshot from Q3 2025.
The good news is that stabilization is evident. In Q3 2025, JRVR's combined ratio improved significantly to 94.0%.
Okay, and how does that break down?
That breaks down into a loss ratio of 65.7% and an expense ratio of 28.3%.
A 94.0% combined ratio is good. I mean, that's a small but solid 6.0% underwriting profit.
It is.
That's definitively profitable and far, far better than the loss-making ratios we saw last year.
Okay, now let's temper that enthusiasm with a dose of reality. Let's compare that 6% margin to the gold standard. Kinsale. Kinsale's combined ratio is around 75%.
Which translates to a 25% underwriting margin.
They're 4 times more profitable on every single premium dollar.
That comparison is the single most important unit economic data point in this entire deep dive. James River has a 19-point margin disadvantage versus the best-in-class operator who have to break down those 19 points.
We can break it down structurally. 8 of those points are due to the structural inefficiency of their expense ratio, that higher-cost wholesale broker model we discussed.
And the other 11.
But a crushing 11 points are due to worse underwriting. This is pure risk selection failure. They are taking on risks that are 11% more costly to insure than the industry leader.
So if they're 19 points behind, they can't compete on efficiency or cost.
They can't.
which means they're forced to compete only on access. They become the carrier of last resort, forced to take the risks that Kinsale, RLI, and the other disciplined carriers refuse to touch.
And that competition strategy inherently leads to higher volatility and a much higher potential for reserve charges down the line.
This is why the whole investment thesis requires faith that the current management has the skill to navigate those hypervolatile risks without making the same mistakes as the past.
They have to underwrite perfectly in the most difficult segments of the market to make a 6% margin, while Kinsale gets a 25% margin in the easier segments.
That is the definition of operating with one arm tied behind your back. Okay, but one thing that is universally helping the company, even with its structural weaknesses, is the industry environment. The hard market benefits everyone who can raise prices.
It's a major mitigating factor. E&S renewal rates increased 8.6% in Q3 2024.
And then they jumped even higher.
13.9% in Q2 2025. That kind of pricing power acts as a buffer against poor underwriting and structural cost disadvantages.
If prices are going up 14% a year, even a mediocre underwriter can look good temporarily.
For a while, yes.
But here's an interesting signal of management discipline. Their gross written premiums, their GWP, are actually flat or declining. Why would a company in a hard market choose not to grow?
Because management is intentionally shrinking the book and prioritizing quality over quantity. They are actively shedding bad risk.
What specifically?
Specifically, they were cutting the volatile fronting business, which was down 73% in Q3 2025.
And that is a fundamental sign of a disciplined manager, choosing value over volume.
It is. They're sacrificing top-line growth optics today, which Wall Street loves, to ensure the quality and stability of the balance sheet tomorrow.
They're not trying to grow their way out of a solvency problem. They're de-risking their way out, which is the key necessity in a turnaround like this.
It shows they understand the painful reality of their history. Okay, now we shift fully to the forensic accounting to test the core assumption of this whole turnaround thesis, which is that the strategic changes are actually stabilizing the balance sheet.
As the source material puts it, in insurance, net income is an opinion, cash is a fact.
And reserves are a promise. And James River has consistently broken that promise.
So let's detail the chronology of these cockroaches, the adverse development charges that have destroyed investor confidence and book value over the last half-decade.
The history is just a saga of surprises. It started immediately after they canceled the Uber contract with major commercial auto charges in 2019 and 2020. Then in Q4 of 2021, they had a huge, unexpected $115 million charge in casualty reinsurance, and the drip just continued.
And the market might tolerate one or two massive charges if they're truly unexpected, but the consistency is the real problem.
Exactly. We saw major hits again, a $57 million charge in E&S in Q3 2024, followed by the latest one, the $51.3 million charge in Q3 2025.
And that's related primarily to which years?
Accident years, 2020 through 2022. This history is why the stock trades at $6.31. When an insurer takes major reserve charges 5 times in 6 years, you have to assume their actuarial DNA is just flawed.
So the entire investment thesis rests on the hope that this chronology has finally definitively ended.
The market simply assumes there's always another cockroach hiding in the walls.
Okay, this brings us to the crucial pivot point. Management recognized they couldn't just promise they'd do better. They had to actually buy protection. They executed this walling off strategy by buying insurance for the insurer.
They did this via 2 main mechanisms. First, they sold the toxic JRG re-unit, that's the ultimate clean break. And second, they purchased those expensive adverse development covers, the ADCs and loss portfolio transfers, LPTs, from specialty reinsurers like NSTAR and State National.
And that gave them about how much cover?
About $160 million in cover above their existing reserves for past years.
Can you clarify the difference between an LPT and an ADC in simple terms for us?
Sure, let's use a property analogy. An LPT, a loss portfolio transfer, is like selling an old, leaky house completely. You transfer the asset and all the future liability for repairs to the buyer in exchange for a large upfront fee. It gets the mess entirely off your balance sheet.
Okay, so that's selling the problem. And the ADC, the adverse development cover?
That's more like buying an extended warranty on the old leaky pipes. You keep the house, but you pay a massive premium to a warranty provider, the reinsurer, who agrees to cap the repair bills you'll have to pay later.
So if the claim development turns out to be worse than your estimate?
The reinsurer pays, up to that $160 million limit. It sacrifices future earnings because the cover is very expensive, but it guarantees protection against a catastrophic solvency event.
So why does the most recent $51.3 million charge in Q3 2025 matter so much?
That charge provides the critical forensic insight we've been looking for. It was immediately and fully ceded to the ADC. Meaning that N-Star and the other reinsurers are the ones paying that $51.3 million, not James River shareholders.
So this is the first concrete functional proof that the third-party capital protection is actually working.
It is. In other words, the balance sheet bleed for existing shareholders should now be capped, assuming the total accumulated charges don't breach that $160 million limit.
The toxic past liability is now effectively ring-fenced.
That is the core assumption that shifts JRVR from a pure value trap to a speculative cigar butt. The fact that the charge was recognized but immediately ceded proves the protection mechanism is functional. The company bought itself time and safety, sacrificing future earnings capacity for immediate balance sheet integrity.
Let's look at the financial trauma in more detail. Book value per share, or BVPS, is the proxy for intrinsic value in an insurance company. And JRVR has destroyed over 60% of its book value in 4 years. It was a capital allocation disaster of the highest order.
It collapsed from a stated peak of around $25 in 2021 and an early tangible peak near $18.40 down to $10 in 2024.
And today, the most relevant metric is tangible book value per share, TBVPS, which stands at $8.24 as of Q3 2025.
And the stock trades around $6.31. This means the stock is priced at a deep discount, 0.76 times tangible book value.
Which brings us back to that famous Buffett rule. Buying a dollar for 76 cents is only a good deal if that dollar isn't shrinking to 50 cents next quarter.
And the market's price today implies investors absolutely believe that dollar is still shrinking because of those unseen reserve charges.
But are we seeing a trend reversal signal?
We are. Tangible common equity actually rose 23.4% in the first 9 months of 2025.
That's a huge move.
It is. And it suggests that the stabilization management actions, selling the bad reinsurance unit and walling off the legacy liabilities, might finally be establishing a floor for the book value. The past is still painful, but the balance sheet is no longer actively bleeding.
Now, quality insurers need a consistent return on equity, or ROE, above 15% to compound capital. JRVR has been nowhere near that, posting negative ROE for multiple years, 2021, 2023, 2024. They were destroying capital, not compounding it.
Correct. You cannot be a sustainable enterprise if your ROE is consistently negative. You're constantly losing value.
But the Q3 2025 results give us that powerful green shoot we've been looking for. They reported an annualized 19.3% adjusted operating ROE.
That number is almost unbelievable given the history.
It is.
This number is the entire turnaround thesis distilled into one single metric. It's the first flash of Buffett quality returns in years, and it strongly indicates that the current underwriting book, the business written under the new management since 2023, is highly profitable.
The new engine is running efficiently after the toxic legacy business from 2014 to 2022 was ring-fenced.
That's the theory.
Wait, I have to challenge that number. You just told us management has a terrible credibility problem regarding their estimates, and they just took another massive charge. Why should we believe the adjusted operating ROE of 19.3% is real? Isn't that just window dressing aimed at placating investors?
That's a crucial point of skepticism, and you shouldn't blindly trust it. However, the reason to believe it is twofold. First, that 19.3% ROE is based on the 94% combined ratio we already verified, which means the current pricing environment is extremely favorable. Second, the heavy lifting of admitting losses has been done. The fact that the $51.3 million charge was taken and then ceded proves management is addressing the legacy issues while the current operating numbers look strong.
So we have a clear operational distinction now. The balance sheet is still stained by the past, but the operating engine of the company appears to be running profitably in the present, protected by those expensive insurance covers.
That is the hinge of the entire investment thesis.
Okay, we've conditionally passed the qualitative tests and confirmed the core unit economics are improving, even if they trail the industry leaders significantly. Now we have to calculate the intrinsic value and apply a margin of safety that's appropriate for a business with such a painful history.
Right, we need to triangulate value using both Graham's liquidation approach and Buffett's earnings power approach.
Let's start with method 1. Adjusted liquidation value, Graham's net. We start with the hard floor. Tangible common equity per share of $8.24.
This is the stated asset value available to common shareholders.
But can we trust it?
Given the history of reserve failures, we cannot trust that number completely. So we have to apply a significant 15% cockroach penalty to the TVVPS.
Just to account for the ongoing reserve uncertainty, even with those ADC covers in place.
Exactly. It ensures a deep margin of safety.
So $8.24 minus that 15% penalty gives us an adjusted intrinsic value for liquidation of approximately $7 per share.
And since the stock trades today at $6.31, it is trading below the discounted liquidation value of its tangible assets. That is the pure Graham cigar butt signal.
Okay, now let's test the upside. Method 2. Earnings power value, or Buffett's owner earnings. If the turnaround is successful, if that 94% combined ratio holds and the asset base is stable, what can this company earn?
We can project a normalized net income. They have roughly $1 billion in premiums. If we apply that stable 6% underwriting margin
From the 94% combined ratio.
we get $60 million in core underwriting profit. Then we add the investment income, about $1.4 billion in assets yielding a very conservative 4.6%, which adds another $65 million.
Okay.
After subtracting taxes and the preferred dividends, we arrive at a normalized net income to common of about $65 million.
And you divide that by the 46 million shares outstanding.
And you get a normalized earnings per share of $1.41.
That's a powerful number. Now we have to apply a multiple. A best-in-class insurer like Kinsale trades north of 30 times earnings, which is just ridiculous for JRVR.
Completely inappropriate.
But JRVR is a broken company trying to fix itself. So a modest show-me turnaround multiple of, say, 8 to 10 times earnings feels appropriate.
I agree, and the resulting valuation range is substantial. 8 times 141 is $11.28 per share.
And 10 times 141 is $13.10 per share. The upside potential is clear if the stabilization holds. And this is where the opportunity becomes asymmetric and why we're diving so deep into this. The current market price of $6.31 is telling a story of fear.
It implies the market is priced in James River at 0.76 times tangible book and only about 4.5 times normalized earnings.
So the market is pricing this company as if it's facing imminent insolvency or another massive reserve charge that will breach those ADC limits.
They are focused only on the historical trauma.
So the core insight here is that if you pay $6.31, you're paying less than the adjusted penalized liquidation value of $7.
Correct. You're paying for the assets, assuming they liquidated at a discount. Therefore, the future earnings power of the stabilized ENS franchise, the ability to earn $1.40 per share annually, is obtained for free.
You get the assets, and the profitable business is the bonus, the free call option.
That's it. And this yields a very favorable reward-to-risk ratio. The downside is estimated around $4 if the book value truly erodes further.
But the upside, if the turnaround succeeds and they achieve that 8 to 10 times multiple, is $12 to $14.
Which gives you a favorable 3-to-1 reward-to-risk ratio. That is the definition of an asymmetric setup suitable only for speculative capital.
But this is speculative, and we absolutely must define the kill criteria, the factors that would cause this entire thesis to fail.
Number 1, breach risk. This is the most acute risk. If the reserve development unexpectedly exceeds the limits of those expensive ADC covers, that $160 million fence, the balance sheet bleed returns directly to shareholders.
And the price will collapse further.
Immediately. Number 2, rating risk. An insurer's lifeblood is its AM Best financial strength rating.
A downgrade below A would severely damage the ENS franchise because wholesale brokers and clients would just lose all confidence and refuse to do business.
And JRVR currently maintains that A rating, but any restructuring like this always carries the threat of a negative outlook or a downgrade.
And number 3, loss of broker faith. Even if the rating holds, if wholesale brokers lose faith in JRVR's longevity and stability, premium submissions will just dry up, starving the company of volume.
But there is a mitigating factor here. Current data showed submission volume was actually growing in the ENS segment.
I saw that around 16% in Q2 2025.
Right. And this suggests that despite the balance sheet trauma, the underlying franchise value and the broker relationships have survived.
So the investment really rests entirely on the assumption that the cockroach theory has reached its limit due to the hard fences of those reinsurance covers.
You're betting that the CEO's insider buying is a signal that the worst surprises are finally in the past.
Okay, let's try to synthesize our deep dive here.
James River Group Holdings is definitely not a compounder. It's a highly speculative, deep value turnaround situation that is priced for failure.
The green shoots are real. The 94% combined ratio, that 19.3%, operating ROE, but they are new and unproven over a full cycle.
And the core confidence booster is the walling off strategy, which is protecting those green shoots from the toxic legacy of the past.
So it's an asset where you're paying 76 cents for a dollar, and you get the future earnings engine thrown in for free, provided you believe the floor is really $7.
But it requires the investor to actively monitor those reserve tables quarterly, ensuring those ADC limits are holding and that the new management isn't creating new expensive tails of bad business.
It's not a set-it-and-forget-it investment.
Not at all. Now let's connect this analysis to the bigger picture, something for you to mull over long after this deep dive is over. If we step back from JRVR's specific management failures and the Uber wound, the ultimate risk in this casualty-heavy segment isn't just bad underwriting today. It's the systemic pressure of social inflation.
Those massive nuclear jury verdicts in U.S. courts that retroactively destroy perfectly good actuarial assumptions.
Exactly. Social inflation means that even perfectly reserved underwriting books from 5 or 7 years ago are being impaired by courts today because the value of liability has just escalated so rapidly.
So the question for the long-term learner is this.
How robust can any E&S balance sheet be when society's litigation risks are escalating this fast, making the estimation risk almost impossible to manage reliably?
That is the ultimate macro risk hanging over the entire casualty insurance market. And JRVR, being 96% casualty exposed, sits right at the epicenter of that systemic pressure.
Which is why close monitoring is absolutely non-negotiable for this stock.
So ultimately, this is a deep value asset that offers asymmetric upside, but only for those willing to accept significant complexity and monitoring risk.
A very specific type of investor.
And before we close, a necessary reminder. All the analysis here is based on publicly available sources and is purely for educational purposes. We are not investment advisors.
This content does not constitute investment advice. We strongly stress the need for you to conduct your own due diligence before making any investment decisions.
And if you found this level of forensic deep dive analysis compelling, and you want to access more advanced content, welcome to join the Deep Value Club membership.
You can find us and subscribe on Apple, Spotify Podcasts channel, Deep Value Investing, and at luluvc.com.
We'll catch you on the next deep dive.